They called me crazy when I said I wanted a 30+% yield while growing my portfolio. They said it couldn't be done. They said it was too risky, but here I am, sitting on a roughly $160,000 portfolio that's generating nearly $46,000 in annual passive income after tax. That's a 31% yield on my investment, while still growing my capital by over 24%. And this isn't theoretical, these aren't projections, these are real numbers from my actual portfolio. We are looking at a 24% internal rate of return with almost $33,000 in total profits. And today I'm going to break down exactly how we are engineering these returns. Welcome to Psycho Investor, where we don't just chase yields, we engineer them into a wealth-building machine. Quick reminder, if you don't like my Eastern European accent, just turn on the subtitles, mute the sound, and collect that valuable information. First of all, look at how we structured this portfolio. Our three largest positions tell the story. BITO at 28%, QYLD at around 19%, and METY at around 13%. This isn't random, this is carefully engineered for maximum effectiveness with managed risk. Let's start with our largest position, ProShares Bitcoin Strategy ETF, BITO. And quick reminder, if you want to invest in it from Europe, you should try BITO KZ from the Kazakhstan Stock Exchange, so you can access it from Europe without being professional investors. At over $45,000, it's generating massive returns, 96.55% internal rate of return, with over $10,000 in dividends received and nearly $7,000 in capital gains. That's over $17,400 in total profit from just one position. Next up is QYLD, our covered call ETF on the Nasdaq 100. With over $30,000 allocated, it's providing a steady income with 6.34% internal rate of return. While this might seem modest compared to our other positions, it's a crucial part of our income foundation, consistently generating cash flow regardless of market conditions. Now let me show you something that most investors completely miss. Main Street Capital, ticker MAIN. We've allocated over $20,000 here, and the results speak for themselves. 45.23% internal rate of return with $951 in dividends and almost $5,000 in capital gains. That's a total profit of nearly $6,000 or 38% on our investment. Now we'll move into our income shares plays. Let's start with our S&P 500 exposure through SPYY. At 2.36% of our portfolio, or about $3,700, this position uses zero-day to expiration option strategy. When others are afraid of market volatility, we are collecting premiums from it. We've already received $178 in distributions, and even with some market turbulence, we are showing a 1.2% total profit in a month. Moving to our tech sector plays, METY, our meta options ETP, has been an absolute beast. With a 50% internal rate of return and 2.21% portfolio allocation, it's generated $83 in distributions while giving us over $512 in capital gains. That's what I call making social media work for us. Our Nasdaq exposure through QQQY takes up 2.25% of the portfolio. Even in challenging market conditions, we've collected $256 in distributions. This position perfectly demonstrates how we can generate income regardless of market direction. NVDI, our NVIDIA options positions, show exactly how we handle high volatility tech stocks. With 1.86% allocation, we've already collected $107 in distributions. The beauty of this strategy is that we are not just betting on NVIDIA's stock price, we are monetizing its volatility through sophisticated options strategies. Then we've got COIY, our Coinbase option position at 1.68% allocation. This has been a perfect example of our income-focused approach. We've collected $383 in distributions, showing how we can generate significant income even from volatile crypto-related stocks. Now let's talk about what makes this portfolio truly unique, our growth engine, and how it works in perfect harmony with our income positions. Let's start with TQQQ, our ProShares Ultra Pro QQQ position. European investors, use QQQ3 if you want to replicate my position. At 4.6% of our total portfolio, it's showing a spectacular 64.27% internal rate of return. We are already up $1,870 in capital gains while collecting $30 in distributions. But here where it gets interesting. This position acts as a perfect complement to our QYLD core holding. Same underlying index. Both track Nasdaq 100 but profit from different market conditions. When markets rally strongly, TQQQ provides amplified gains while QYLD provides steady income. When markets move sideways, QYLD generates enhanced premium income while TQQQ decay is minimal. During volatility, QYLD's option premiums often increase while TQQQ provides opportunity for averaging down. And now let's move to Tesla strategy. It shows exactly how we combine different approaches for maximum effect. We've got direct Tesla stock at 1.35% of our portfolio, showing an incredible 200% internal rate of return with $644 in capital gains. Then we've got TSL3, our leveraged Tesla ETP at 0.48% allocation, but we are not done. We are also running TSLAE, our Tesla options ETP at 1.47% allocation. The synergy of this strategy works through multiple profit sources. We capture capital appreciation from our direct stock position, achieve amplified gains through leveraged, and generate regular income from options premiums. All these work together to create a comprehensive profit structure. Our market condition coverage is equally comprehensive. During strong uptrends, both our direct stock and TSL3 positions capture significant gains. When the market moves sideways, TSLAE keeps generating premium income. In high volatility periods, TSLAE premiums increase while TSL3 provides excellent trading opportunities. Even during downtrends, our option premiums helps offset potential losses. The risk management aspect is carefully engineered. Our position sizing precisely matches risk levels, with the smallest allocation going to our most volatile instrument. The income component helps reduce overall position volatility, while different entry points effectively averaged out our cost basis. So, having multiple ways to profit significantly reduces our dependency on market direction. The psychological benefits of this approach are substantial. Regular income generation makes holding the position easier through volatility. The leveraged portion satisfies our aggressive growth goals, while the direct stock provides a long-term investment foundation. Having multiple positions reduces the pressure on any single strategy. This combination enables us to capture Tesla's growth potential while generating regular income. We can amplify returns when appropriate, manage risk through diversified approaches, and profit in multiple market conditions. It's essentially turning a single stock into 3 distinct profit centers while maintaining strict position sizing discipline. The total Tesla exposure of around 3.31% through our combined position gives us significant upside potential while keeping risk in check. And now, let me show you something that separates real portfolio engineers from gamblers, our risk management framework. When people see our 30+% portfolio yield and 20+% internal rate of return, they often think we are taking crazy risks. But look closer at how we structure this portfolio. Our risk management starts with what I call stability triangle: BITO, QYLD, and METY. Together, these 3 positions make up 62% of our portfolio. This isn't a random number. BITO at 28% gives a strong yield with growth potential. QYLD at around 90% provides steady options premium income regardless of market direction. METY at around 13% offers both reliable dividends and private market exposure. We also maintain strategic cash reserves, currently around $11,000 or about 7% of our total portfolio. This isn't dead money sitting around, it's our opportunity fund, ready to deploy when market volatility creates attractive entry points. These numbers prove that with proper portfolio engineering, you don't have to choose between income and growth. We're generating almost $46,000 after tax in annual passive income while growing our capital by over 22%. If you want to learn more about how this portfolio will perform in the future, smash that subscribe button and hit the bell, because sometimes the craziest thing you can do is play too safe. Stay psycho, stay profitable.